Hi everyone, I'm so pleased and proud to be here to join you for the 8th Wanxiang Global Blockchain Summit. My name is Cong. I'm a professor at Cornell University. As many of you know, Cornell is home to IC3. It is the birthplace for the first study on proof of work. We also introduced a cryptocurrency about 10 years before Bitcoin. Cornell has the most number of blockchain course offerings and has been leading the fundamental research in blockchain and DeFi. I myself have been researching on fintech and blockchain since 2012. And what I hope to do today is to share with you some interesting directions for research and for applications of economics in Web3. And what I do is going to be different from the usual practice where I focus on one single paper. I plan to stay at a fairly high-level perspective and touch on several studies that we have. So I'll start with economic design in distributed systems. We've seen game theoretical studies and mechanism design related to consensus protocols, oracle networks, DeFi markets, fee mechanisms. Professor Zhiguo He and I have probably the first study on the economics of using smart contracts. There are also studies on the design of monetary policy, the tokenomics of blockchain-based systems and platforms. That's not something I'm going to focus on. What I want to highlight is a new area that's related to the design of reputation and identity. The second general area I'm going to touch on related to data usage in Web3. Data is going to be very useful for classification of digital assets, valuation of tokens. It's going to help regulators to detect manipulation, so on and so forth. I'm going to briefly speak on that, but one application or one direction that I'm really excited about is the use of blockchain for antitrust purposes, for the sharing and governance of data. And I'm going to use the word data DAO for that. And after that second section, I'm going to move on to the third section, which is related to the theme of this year's conference or summit. That is the sustainability and environmental impacts. It could be the direct impact of blockchains, or it could be how blockchains help us to tackle other environmental issues. In particular, I'm going to highlight a very promising field using blockchains and crypto for carbon neutrality. To start off, let's look at the economic designs in distributed systems. On this slide, I'm just showing you a number of recent studies, either working on protocol design or fee mechanism design. My colleagues, Dave Isley and Maureen O'Hara, have contributed to fee mechanisms in Bitcoin. And my co-authors and I have developed the first dynamic valuation model for tokens, as well as optimal monetary policy design for token-based platforms. And Professor Tang is going to speak on staking. One recent study that we have actually relates to fee design, and that's an area that's still wide open and very important. For example, in this study titled Inclusion and Democratization through Web3 and DeFi, what we see is that even though Web3 and DeFi are widely advocated as innovations for greater financial inclusion and democratization, when we actually conduct this first detailed investigation using Ethereum data, by the way, Ethereum covers over 93% of DeFi activities, we actually saw concentration in mining and ownership of ETH. They're concentrated in a small number of exchanges and individuals. Top 5% individuals receive over 70% of the rewards. And some people might say that's problematic. Well, it's going to change with the switch from POW to proof of stake in a couple of weeks. What we also observe or document is that there's a evolution, shift from carrying out most of the transactions using ethers to using higher layer tokens. We also see a shift from peer-to-peer interactions to transactions that were carried through DeFi protocols, so dApps. Interestingly, we find that fee design is actually not inclusive at all. It's unfavorable to small players, and it's quite intuitive. There's a fixed fee, gas fee for transactions or computation within the Ethereum ecosystem. Whether I'm transferring $10 or $1 million, I pay roughly the same amount of fixed cost. And in terms of percentage, that's hurting the small players. And there are also issues related to the volatility of gas prices, the uncertainty involved in setting the gas reserve. All those lead to high transaction failures, which defies inclusion and democratization of financial services. But not all hope is lost. The recent upgrade to EIP 1559 and also various airdrop programs actually help with inclusion, and that's something we discuss in detail. The burning of base fee under EIP 1559 is actually a redistributive policy, right? You are collecting fees from the large players and burning them. When you burn them, it's a so-called deflationary action that's going to benefit all token holders. So it's very much a redistributive monetary policy in that context. And on this next slide, I'm just showing you how burning is related to monetary policy. Or burning actually shows up in luxury goods as well. There could be incentives for a platform or a firm to burn durable goods in order to boost the franchise value going forward. And this is very much related to central banks' management of monetary supply as well. In the interest of time, I can't get into the details, but let me just move on to this new direction that I think is quite exciting. That's related to reputation and Web3 identity. If you've been paying attention to how the consensus and DeFi protocols are designed, most of them are still using static incentives. Right? Per round of block building, how do we incentivize proper behavior? Now, reputation is actually a form of dynamic incentive. It has a long history, and it actually presents an opportunity for platforms to recognize and also incentivize decentralized contribution. That could include consensus generation, content creation, community building, or even gameplay, which are all very crucial for the growth and sustainability of Web3. And yet, designing reputation systems requires complex considerations. And we have yet to agree upon the best ways to do that. And that's what I think constitutes a very interesting research direction. Now, the fact that reputation is persistent, it's carried through on-chain, means it can be a building block for online identity. Right? In Web3, we have the likes, we post our photos and all that, but it's all within a particular app or platform. And you might say, okay, fine, now we have interoperability. So it's no longer a problem. I can port my ID over, but that still relies on the intermediation of centralized parties that's prone to attacks and manipulation. Web3 is based on the premise that each internet user will have a unique internet identifier, just like we have an email address or a driver's license, and that's linked to the software stored on a blockchain. And your online activities, on-chain activities, or even off-chain information that's fed on-chain can be carried with you, right? And for example, your crypto wallet would function as a sort of a profile, similar to Facebook profile or LinkedIn profile. But unlike Web2 profiles, decentralized identities are backed by hard evidence. There's a permanent time-stamped record of your past activities on the ledger. And there's a number of startups exploring this direction. Violet, Rabbit Hole, Kudos. I've been advising Chainlink for some work along this direction. Right? These startups try to authenticate off-chain personal identifiable information on-chain. They allow users to record professional achievements or create a customizable NFT to be used later. Okay? Now, reputation is a complex topic. We could get subjective metrics or objective metrics, right? Sometimes we can have people's rating. We can also have a hard metric on how long it takes for you to provide the information feed. Information could be on-chain and off-chain. It could be collected passively out of your regular activities on-chain, or actively by generating an NFT, right? In order for you to apply or carry out activities on another platform. And finally, the platform itself could be centralized or decentralized, and that has different implications for the design of reputation system. Now, I'm just going to briefly touch on a recent study I have looking at staking and reputation in decentralized systems. Now, without going into the details of the model, in very broad strokes, we have agents performing certain tasks, and they get a reward W. The reward per period is given a fixed amount, and how much individual gets depends on the allocation function, which could be probabilistic. What is key is that the arguments for the allocation function include staking, denoted by S, and reputation, denoted by R. And the reputation score could be coming from both subjective and objective metrics. And if you do some variance bias optimization over there, you can figure out the optimal ways. And each agent's problem becomes an optimal control problem. And they need to decide how much to stake in order to manage their reputation dynamically, as well as receiving the rewards for the tasks they are performing. And the task could be consensus generation, in proof of stake. Now, introducing reputation on blockchains can help reduce concentration and market power, as we would find. It's going to help backload incentives, just like any dynamic contract, which means it's less costly to incentivize proper behavior. It's going to tie users more to the ecosystem so that they care about the long-term evolution of the system. And it's going to encourage entry. If in the traditional rating-based system, new entrants is very hard to compete, right? But now they can stake some amount in order to enter the competition. That's what we observe in Taobao. And new online merchants actually can post some collateral, and if they don't behave, it's going to be slashed. Similarly, if you don't have a deep pocket, but you have good reputation, you can also enter the competition. And overall, that's going to improve user welfare and so on and so forth. Now, let me move on to the second area. That's the use of Web3 data. Data can be used to classify and value tokens and digital assets. In this book chapter on categories and functions of crypto tokens, I do talk about the 4 different categories of tokens that would help us to conceptualize and categorize different digital assets. And using thousands of crypto tokens observed, you can actually develop pricing models, factor pricing models. And that's what we'll do in the recent study. But more importantly, we do show there's strong segmentation across the categories. That's going to be informative for practitioners. Now, data can be used for detecting cyber crimes, ransomware attacks, or manipulation, tax evasion, and faked transactions, right? Which is called wash trading. In this study, crypto wash trading, we actually use blockchain forensics to detect faked volume. And the graph I'm showing you here relies on behavioral economics, in the sense that we do know people tend to round off numbers, right, when they place an order and complete the transaction. So the frequency of transaction size around 5s, multiples of 5s, multiples of 10s should be higher. And that's what we observe on regulated exchanges. But on unregulated exchanges, what we see is that the pattern is actually very irregular. There's no spike around round numbers, and the distribution of transaction is also off. Now, we can use alternatives such as power law distribution of the tail of transaction sizes that people have observed in equity market and other asset markets. And if we apply that to crypto, we also see regulated exchanges show patterns consistent with power law, whereas unregulated crypto exchanges, which tend to fake their transaction, right, in order to attract more liquidity to the exchanges in question, they exhibit very irregular patterns. But within this space, what I think is really exciting is the concept of user union and data DAO. These are concepts that we introduced in a theory study on antitrust regulation and user union in the era of digital platforms and big data. We've seen many initiatives and policies protecting users' privacy, enabling open data, open banking. But the challenge is that a small number of large companies still dominate, and these regulatory policies would have their own drawbacks. Now, fintech, with the decentralization and blockchain-based technologies, could potentially help here. But the caveat is that we need to have the right design. We need to understand the economics first. Now, in this modern era, I think we all recognize that in addition to capital, land, or labor, users now contribute to the production quite significantly, right? Because they add to the network effect. They also provide data, which in turn improves services and products. So the inefficiency lies in the fact that users don't quite internalize the impact of their data generation sharing on other users, and also on the market power of the platforms involved, and also on the incentives for the platforms to improve their infrastructure in order to provide better services and also generate more data. Now, in the study, we propose this concept of user union, which is implemented through Data DAO, basically a DeFi protocol where individuals can collectively bargain with the platforms and get properly compensated, and at the same time internalize any effects they would have on the industrial organization and market power in the economy. And in this plot, we're just showing how the user union solution compares with policies such as GDPR, CCPA, or open banking initiatives in Europe, which is more mandatory, and also those in the US, which is more market-based. And overall, we do see that the user union can mitigate many inefficiencies and dominates other policies in terms of user welfare. So that's an open area. I haven't seen well-developed projects or startups working on this data governance and sharing issue using blockchains. And I think that's an area that more research is needed, and more applications will probably emerge. Finally, let me come to the third area, which is related to sustainability and environmental impacts. Now, to start, I would touch on the direct impact of mining, crypto mining. There has been a lot of discussions on proof of work versus proof of stake, which is all very valid. I think there's also a point to be made related to how financial innovation interacts with the impact. In this study, Decentralized Mining and Centralized Pools, jointly with Jibo and Justin, we offer a first study highlighting the fact that mining pools has been rising. It's going to exacerbate the environmental impact. And the idea is that it's a financial innovation, allowing risk sharing among miners. And when people are sharing risk, what do? They mine more. And that's going to increase the zero-sum competition to POW. That's bad for the environment. What is not explored at all, and that's my third promising direction, is how we can use blockchains to solve carbon neutrality problems. According to some reports, we need to remove over 20 billion tons of CO2, or CO2 equivalent, from the atmosphere by the end of 2030. And that implies that we not only need to go carbon neutral, we need to go carbon negative over the next couple of years. How blockchains can help? Well, there's already a few pioneering projects looking into this space, which, by the way, is worth hundreds of billions of dollars. And BitGreen, Flow Carbon are some examples. Basically, you can use blockchain to better authenticate certain carbon credits, right? You can originate carbon credits and put the record on chain so that it's easily verifiable and portable within the Web3 space. Blockchain can be used to record ESGs, pollution metrics, and we need to carefully design the tokenomics within the system to incentivize behaviors, and that's something I've been exploring, and I think we have come up with a good solution. The key concept there is we need scarcity for token supply, and the scarcity of natural resources or the capacity to pollute would naturally provide the scarcity for token supply. And in turn, tokens would incentivize more sustainable behavior in the ecosystem. Our team is exploring the design of staking and voting systems within such a platform. And this is an area that requires more research, as well as the collaboration of computer scientists, economists, government officials, and legal professionals. To conclude, I've touched on 3 areas of Web3 economics and highlighted 3 promising directions that's based on academic research. I think further research and industry applications are likely to emerge. And I'm happy to and excited to chat about these topics offline as well. So I'm going to end my talk here. Thank you.